keep reiterating, keep changing, keep modifying, keep trying to make it better, better, better. And then pretty soon what you're left with is a great system for trading the last 90 trades and has nothing to do with what's going to happen in the future and is not going to help you at all.
Two traders, Darren and Walter, pull back the curtain on profitable trading systems, consistent money management, and profitable psychological triggers. Welcome to the Two Traders podcast.
Welcome back to Two Traders. It's Walter here, and in part 2 of this episode, you will see what's the double ace of diamonds card and how it affects traders. You'll also see how Darren uses the poker player exit strategy with his trading and why. You will get the problem with really big winning trades, and this can drive some traders crazy, but it shouldn't, and you'll see why. You'll also learn why focusing on making the, quote, best decision may not be the most profitable way to trade. And finally, you'll get the poker player's rule that can help every trader who pays attention to this golden nugget of truth. All this and more in part 2 of today's episode.
Yeah, absolutely. So they can crunch the numbers and say, 83% of the time when it hits R3, it retraces, 25% of the move from the whatever the daily pivot, the middle pivot, or whatever that thing's called. I don't know what they call it. Anyway, they can do things like that, right? They can crunch all those numbers and everything, and it gives them comfort to say, look, this is what's most likely to happen, and so I'm happy to take these trades. Like, those are the sorts of things that a lot of traders do, especially mechanical traders, right? Automated traders. They do a lot of that stuff. So I'm just trying to figure out the difference. And I guess, between that and the poker player who knows the odds of certain hands and all that. And I guess it's a very good analogy. Like, it fits completely, except for that last piece, which I believe is you're dealing with what I would call a closed system, because there are no double ace of diamond cards or something, you know what I mean? Like that card doesn't exist, you know what I mean? Whereas in trading that, who knows what kind of card you can come up with. It's like unlimited.
Yeah. And the open element is the betting side of it. It's the money side of it. So the poker player, it's hit his R3 and now he's in the trade, he's in the hand, and it's what the other players bet. So, okay, I've got this good hand, I'm in, and then player 3 drops his whole stack. Now the game has completely changed now, because now you still have the same hand, but now if you want to play on, you're going to have to risk your whole bankroll to stay in the game, and now you have to make a decision. It's exactly the same with trading. The price hits R3, you get into the trade, you set your stop loss. Now you have to have a strategy to make the most out of those trades. And what people tend to sort of veer towards is having more winners than losses. So they tend to get out of that trade quicker. But that isn't necessarily the way to make money from it. The way to make money from it is probably more likely to let it run a bit further and then start cutting your losses short of the winner by some sort of trailing stop. In my mind, that is the most profitable way to trade. Is to try and make the most out of your winners, but when you've got a decent win on the table, then you need some sort of trailing stop. And I think that is where the most edge can be found. That's my belief. I'm not saying I'm right, but that is 100% my belief. And that's why I don't really focus on the entry. I'm thinking more about the exit side. I think for me, that is the better strategy. And I think, maybe a lot of poker players think that way as well. For sure, there's the good poker players, they'll wait for specific hands, they'll play them, but then if everyone else comes in really heavy, then, they might say, right, okay, this was a good hand, but it's looking like everyone else has got a good hand, so, I'm going to move my stop up and get taken out, and I'll wait for the next hand. I believe that's probably how they're playing it.
Yeah, that makes sense. See, I think it's different from trading. And the way you were describing, you were saying how you and I are playing poker and I push all my chips in. And so that forces you to make a decision. You either dump your hand right there or you have to go all in too, or whatever, or match my bet, or whatever it is, and whatever the rules are, I don't know. But that, you have to do that. But in trading, if I'm in a pound yen, like right now, I'm in a pound yen sell trade, and it hasn't quite reached my target, and I have another position with a trailing exit, but like it's retracing against me now. It hasn't hit my break even stop, but it's retracing against me, and I don't have to take another position or take on any more risk, even though it's going against me. Whereas if I'm in a poker tournament and someone goes all in, they're sort of forcing my risk management rules to get a little, what I would consider to be quite risky. That's kind of, I guess that's the nature of poker. Whereas in trading, you don't necessarily have to do that, right? You don't have to. I mean, it may be our instinct to do that, but we don't have to, right?
No, but you're looking at your account balance. No more of that is at risk, but your equity is at risk. If you're 5R up and you do nothing and price comes all the way back, that's still lost 5R. The fact that you hadn't already banked it is by the by. That was profit that you had that you could have taken, and you've given that back. So the bigger your win, imagine if you're a trend trader and you've been holding the trade for 3-4 weeks and you're up 30R, then you've got 30R that's open to risk. One massive crash in whatever you're trading, and you could lose all of that. So I think it depends if you look at it from trading balance or equity.
Yeah, that makes sense. That makes total sense. Yeah,
that's why I think trailing stops work so well, because there's this notion that you've got to like trail it behind every bar. You don't. You can just take a trade and let it develop, and then okay, well, it's gone 20R or 10R. Now I can I'll lock in 4R. So you've locked in some profits, but you're still letting the trade run. And personally, I think it's one of the most underutilized tools in trading. But that's because it's so difficult to do.
What using a trailing exit, or what do you mean?
Using a trailing exit, because we want to find the definitive rules. We want to find, okay, at 3R move to break even, at 5R lock in 1. We want to be able to design a simple rule set, and that always be the best. And it'll be great for a while, and then you'll get one that just doesn't fit the program, and you'll lose a lot, and then you'll change it, and you'll change it again. Whereas I think really what you need is just kind of some loose rules to it, really, because you're not going to find you're going to find the optimum for the last 100 trades, and then the next 100 trades it would have been a completely different pattern. So you need to kind of stop worrying about getting it perfect all of the time. What you need to worry about is that you're catching some really big winners, and some that go your way for a bit and come back aren't complete losses. So you just kind of need to find a balance, really.
Yeah. That makes sense. Yeah.
And we don't like that, do we? We want to know that we have got the optimum X, or whatever it's called, for every element of our strategy. That's what we want to know. And if it turns out bad 1 or 2 times, then we change it and we look again.
Yeah. I think a part of that too, of that trailing exit problem, is that we don't like giving back what we already have. So we don't like the fact. I mean, the fact is, with a trailing exit, you're always going to give back some equity in the trade. Like, you had 400 pips on the trade and you get cashed out at 360 or whatever, right? Yeah,
that's I think that's more painful. And the funny thing is, with a fixed target, you'll often do that anyway. If you look at all of your fixed target exits, you'll see that so many of them went further. And you could say this about every exit. Almost unless it's like right at the low of the year, pretty much, or right at the high of the year, pretty much every exit is not going to be the optimal exit. But we kind of live with this belief that we're going to write the system that gets us that optimal exit all the time, and we really hold on to that belief strongly.
Yeah, no, you're right, and that reminds me of the harmonic traders who have these crazy patterns. That I think part of the draw of these harmonic patterns is that they say, look, okay, if you see this pattern, then this is your target. Like it's going to go to here. Like it's going to do this 261 extension or whatever, and that sort of thing. It's trade by numbers sort of thing. Yeah, and that's you just plug it in and go, and it makes sense to people that that it would do that. And I think the clever FEs will look at, and I don't put myself in this category. These traders who look at MAE and MFE, maximum favorable excursion and maximum adverse excursion, and and what they're really trying to do here is grade themselves on their trades and say basically what you were talking about. Okay, well, I had this target, and how much more could I have had on these trades? I don't know that it fits into an average, though. Like if I looked at 600 trades and I said, this is where my maximum favorable excursion was on these trades, and this is the amount that I left on the table, I think you have to be careful, because when you're talking about averages and stuff like that, there's going to be a lot of trades that fall on either side of the mean. And so, how do you deal with that? What do you do?
Yeah. There is a saying, I can't remember exactly what it is. It's something like, you want the best and then you miss the good. And we kind of, because we're trying to find the best all the time, we miss out on the good opportunities.
Yeah.
Can't remember what the saying is.
Yeah, no, but
a pretty good decision a lot of the time will do, and we're trying to make the best decision all the time. And that's, not really what you need to do. You need a long sequence of pretty good decisions rather than just trying to get the best decision.
Yeah, and that's the road that leads to curve fitting, right? When you do that, when you just keep reiterating, keep changing, keep modifying, keep trying to make it better, and then pretty soon what you're left with is a great system for trading the last 90 trades, and has nothing to do with what's going to happen in the future, and it's not going to help you at all for the future trades. The next 100 trades it's a problem. Yeah.
I wonder statistically if the best poker players do throw away most of their hands.
See, that was interesting, and I wonder if someone's actually studied that. That's interesting to me. Yeah.
Yeah, and I think again, a lot depends on not just their hand. It depends on what the other players are doing as well. It's like when the market, let's say you're really cautious with picking your entries and you're super picky about it. But, when the pound is bombing and, it's been bombing all last week and nothing's changed fundamentally and it's bombing again, then, perhaps you should loosen up your entry statistics and, make hay whilst the sun shines sort of thing, There's so many other elements, and as always, we just focus on that particular really stringent entry pattern, and I think that's just a mistake.
But what if the trader has impulse control issues or whatever, and so staying inside the white lines just helps them execute better, and is that something that
I think that's fine. Yeah, but you as long as you're fully aware that it's really other elements that are going to make you money over the long run, and I think that has to come on the money management and the trade management as well, and thinking you can just find a really good entry setup and everything's going to be fine no matter what you do afterwards, whether you go for 1-to-1 or 5-to-1 or a trailing stop is wrong, and that's easily proven by looking at the same entry and comparing different exit strategies and seeing really you should have similar results across them, and I think that would be unusual if ever happens.
Right. That's interesting.
And I've seen it. I've seen random entry tests with random exits, fixed target exits, trailing stop exits, and the gamut of results varies massively. So to me, evidence proves that it's not the entry that holds the biggest edge. I could be wrong, and I'm sure people disagree with me, and that's cool. If you're making money, it doesn't really matter what I think.
Right. Right. That's interesting. Yeah. I mean, I encourage traders to do the random entry test, but with a really high R exit, just to see the power of that exit, because so much is placed on the entry. I think that can be a really useful exercise. And I've heard of traders who, like, if they have a strategy, let's say they have a strategy that uses certain settings on the MACD or whatever to enter into a trade, and then what they'll do is they'll just plug in totally random settings in the MACD, completely different from their trading system to see if the strategy still holds up when you totally change the entries, things like that, to try and figure out, is this just kind of a random result or is there something there? That's the thinking.
Yeah. And I don't want people to think that I'm saying that a random entry is best and there is no edge in an entry strategy. There is, but it's fine, and you need a little bit more than that.
Right. Now, Darren, while we've been sitting here talking about poker players, I've seen this. I'm just reading this book. It's from the book called How to Make $100,000 a Year Gambling for a Living. and it's talking about professional poker players. And it says, professional poker players always consider the size of the pot before making any decisions. And almost all other authors, when describing how to play a hand, ignore the pot size. It says many professionals know that as the pot gets big, hands should be played much differently than when the pot is small. Obviously, they know that the bigger the pot, the less likely it is that they should throw their hand away. Isn't that interesting? So in a large pot, they know that you should try and win the pot instantly, or at least cut down the field with both fair and good hands. And then in smaller pots, you should be more likely to throw away your mediocre hands. So why would that be the case? Why is that the case? Because I don't understand that. I don't understand why that would be the edge. That in a large pot, you should actually go for it basically and get really aggressive. Why is that?
Because let's say there's a table of 5 players and all of the other 4 players have put $10,000 in. So you need to put $10,000 to stay in, but your potential reward is $40,000. You've got a 4-to-1 risk to reward to stay in. With a very small pot, you don't have that risk to reward. And, this is what I always try to say I know people can make profit at 1-to-1 risk to reward, but your edge is slimmer, and I presume that's why he's saying
right. Yeah, that makes sense to me now. Okay, yeah, I see. Yeah, so and it's true, and I think what you're saying about the 1-to-1 systems, they feel really good. It's nice to be, it's nice to be a winner and all that. But as soon as you slip up, as soon as you start to get off your game, or even just have an unlucky streak, even with a 78% win rate, you can have an unlucky streak. And if you don't keep executing your system and you start to switch it up a bit, you can really run into trouble. Yeah, I agree. I mean, it's almost like the 1-to-1 systems with $1 risk for $1 reward. Those systems, I almost want to say they require a different type of trader, like a better, more vigilant, more disciplined trader than. And if you think of it like a scalper who might have like a 0.7-to-1. Right, system. That makes sense. I mean, they have to be very, very disciplined. They have to be. They have to have certain rules in place, and they just can't go off the handle. Whereas, if I'm trading my 39% or 37% win rate system, I can get a little bit sloppy and still come out ahead because the average winner is 4-to-1 or whatever. It's not gonna it's not gonna hurt. It just gives you a little bit more cushion. The downside, of course, is that you got to work on your psychology because boy, is it painful when you're trading a 38% win rate system because you're going to have the most likely result is the next trade I take is a loser. It's demoralizing. Yeah.
And you're just limiting every trade's potential as well. Once or twice a week if you're trading on the lower time frames, or once or twice a month on the higher time frames, there's going to be a trade that just just rockets, and even if you require a higher win rate, I mean, at that 1-to-1, then reduce your risk by half or move to break even and just, give yourself a chance of getting those insane ones where it just goes straight. And that is the thing that happens least often is price just gets up and goes in one direction really hard. But, you want to be in that game. You want to give yourself a chance of getting those at least.
Yeah, absolutely. Yeah. So here's my final recommendation on this poker thing. I know we've taken 2 episodes to get through all this, but I think I really like the idea of trading with multiple, well, you could call it multiple trades, but really it's taking one trade and splitting it up into different exit strategies. So like a trailing exit, a 2-to-1 target, some sort of money management where you're adding to it as it goes toward the target. All of these sorts of things I think make sense because you never really know what's going to happen with this trade. And one of those exits is bound to be the winner. So it's kind of like the way I play roulette, actually. It's funny that you mentioned roulette. So the way I play roulette, I know that it's a losing strategy. I know that it's a negative expectancy, but I play in a way where I've covered a lot of the numbers. So it takes a long time for me to lose my bank on the roulette table. And in fact, you can get to the point where you have a little lucky streak and then just walk away, which is always nice when knowing you're trading a negative expectancy system. But so that's what I would encourage listeners to do, is to think about each trade you take, use different exits, completely different exits, so that if it really goes, the trailing exit takes advantage of it. If it goes quickly to a target, the pyramiding strategy takes advantage of it. And if it just goes a little bit, in your favor, maybe that your target takes advantage of it. And the other ones don't do as well. So that way, it's not so demoralizing, because if you use just one exit strategy, it might make you more money, but it's just harder to stick to, because you're gonna feel like you need to change things up because of what happened on the last trade or the last 5 trades, and that's being human, trying to adjust and change things up. But I think it makes sense to me. What I found to be useful is to split it up and use multiple exit strategies.
Yeah, I really like that idea. I really like it. I haven't tried it, but I need to look at it for sure. For me, the final point really is definitely look at gambling and trading in a different light, because I think people that say that trading is different to gambling, they're in the mindset that the biggest edge they have is selecting their entry, and they might well be right, but as far as I'm concerned, you're kind of missing the icing on the cake there. And I think if you have a kind of broader idea of what makes trading work, then you'll see that there is a lot of parallels between it and gambling.
Cool. Thanks, Darren, for your time, and we will see you next time.
Okay, Walter. Cheerio.